today, I think with technology, with what Amazon's doing, there's a lot of uncertainty where I think it's not viable to have a big supermarket and an expensive piece of real estate. What's going to eventually happen is that stuff is going to come straight to your house. So in this space, in the retail space, it's being disrupted by Amazon. So my point is, you need to look at these longer terms, and especially my view for Carrefour in particular was, you're a shopping market, things are changing, more stuff's done online. 20 years from now, you might not be economically viable at such a big space. You might have to downsize. It might be a different business model. And therefore, my view is I had trouble arguing that it's a 40-year lease today with a break clause in 20 years because there's too much uncertainty in that business environment. Now, maybe with the KFC, I might take a different view because the Kentucky Fried Chicken, I mean, I guess you still have to go to the store and pick up your burger. I don't know if that is disruptive. Who knows? I still think that one is, it's a gray area. But what the standard talks about is the economic incentive, and the point I'm trying to make is the longer time you go, it's more questionable.
Even with the present value model, the longer present values would not be relevant for reporting purposes.
Well, for Carrefour, these are big numbers, because for them it was a big deal. Whether you use 20 years or 40 years was a huge impact. It was a lot of money for them. Because, I mean, for a supermarket chain, this had a very, very large impact on their balance sheet. It depends on your industry. So, the renewal periods, yes. If you're reasonably certain not to take them, then no. And the lease term, what they talk about in the standard is this economic incentive to extend. So what that usually means is you've done significant improvements, or payments in the renewal period, there's not a huge reset rate. So, you know, it's subjective here, the importance of the asset to the operations. So my view, if it's like less than 10 or 15 years, the total lease term, that we could probably foresee in the future. But when you get out to 30, 40, 50 years, I have some problems. And I think there's a stronger argument to say that the decision point hasn't been made yet. I'm not sure what the Big Four are going to do on this. Do you have any ideas? Do you have any retail clients?
Not really.
Yeah, it affects retail quite a bit. It affects retail quite a bit. I don't think banks sign leases for 20 years with 20-year renewals. Because for banks, it's easier to move, I think. But for supermarkets, for fast food restaurants, those are the ones that have the long leases because it's just more common. So again, it's principle-based, right? Yes. The auditors will always argue long. You'll always argue short, correct?
I think in this whole debate of reasonable certainty, right, will the intentions prevail over the economic sense?
No, but if you
emphasize the term a lot, even if it's the renewal period is like let's say 3 years after or 4 years after. So when, as an accountant, judging a reasonable certainty to include that renewal period in the lease term, is the intention going to prevail? Because judging somebody's intention would be a very difficult reasoning. On the other hand, economic sense may give us some arguments.
Okay, here's how I see it. The intention, okay, what is the purpose of IFRS 15, IFRS 16? What are we trying to do? IFRS 16, what we're trying to do is let's put liabilities onto the balance sheet that we think you're stuck with. That's the idea, right? And the idea is if you have a 5-year lease with a 5-year renewal and you spend a ton of money to renovate the building, you're probably stuck with the 10-year lease. So the idea is, on the leasing standard, or conceptually the idea is, we want to show the liabilities you're stuck with. And for you to be stuck with them, it's because there's an economic incentive that makes you stuck. Therefore, if it's just purely a management intent, we intend to renew it, but, you know, if we get a better offer somewhere else, we can move somewhere else. Therefore, there is no economic incentive. You're not stuck with it. So the way I would like to look at it is if you're not stuck with it, it's a 3-year lease. If the business cycle goes down, if there's a recession, and you're not stuck with it, it's a 3-year lease. But if you're stuck with it because of the cap, if you move and you have to do an impairment of your leasehold improvements, that means you're stuck with it, right? Now, there might be an impairment event later. That's a different issue. So I think what is more important is the economic incentive, not the management intent. Because if you have a 5-year lease with a renewal for 5 years and there is no economic incentive, then how could you argue it's a 10-year lease? Your needs might change. Your business might get bigger or your business might get smaller. So the economic incentive is what's most important, not management intention. I know that the auditors will ask you to sign a letter, right? What's your intention? But that's just what auditors do, right? But that doesn't really matter so much to me. I want to see the economic side, not the intention. I mean, obviously, you expect them to go hand in hand, right? If the economic incentive is there, there should be a management intention. And management might say, we're going to move because, and hold on, that means the economic incentive is not there. But a management intention with no economic incentive is a future decision. A management intention with economic incentive is a past decision. That's the perspective. So is a decision past or future, the genuine decision? If it's a genuine past decision, it's a longer lease term. If it's a genuine future decision, it's a short lease term. And all I'm saying in conclusion here is the longer the renewal period is, the more uncertainty, the more likely you're going to say the decision hasn't been made. So with Carrefour, I don't think they made a decision they're going to renew 20 years from now because things might change. The whole industry is being disrupted. 20 years ago, there was no Amazon, right? You used to go to the store. Now people don't go to the store. Any questions on this? It's common sense, isn't it? That's the problem. Is we don't always use common sense, right? We're making it worse. We reassess the lease term when we have a trigger event under our control. So, okay, we've done our lease term assessment. We do it on day one, and that's it. You don't go back and say, oh, there's 1 year left. It's now a short-term lease. Not allowed. What are trigger events? You bought another company. You bought another company, and therefore you might not need 2 offices. So obviously, that's a trigger event. You would reassess the lease term. The option's not exercised, and it was initially expected to be. There's a change in regulatory rules. So when there is a significant event that's going to make you make and reassess the decision, we reassess the lease term. So we do not reassess the lease term on an annual basis. We reassess the lease term when there's a significant triggering event. A significant change in circumstances. You know, there could be a new competition that just came on the market. There could be, you know, an acquisition, a new legal framework. The Chinese are going to sell more stuff and wipe out your business. You're going to get all of the imports coming over. Something significantly has changed.
Say it's about under lessee's control.
Correct.
So not about the regulatory environment. If the regulatory framework changes, it's not in lessee's control. Or do you mean it otherwise?
Well, I mean, there's a significant change in circumstances. Well, the examples they have on the standard are such that you bought another business.
Business model change.
You know, now I think if there's a change in the competitive landscape or something, that's right, driving from the environment. I need to look that one up. I still think I would consider that. But that's a good point. It does say, it does explicitly say from the lessee's control. Yeah, I think it is specific under the lessee's control, not the environment. Not the environment. But if there's a significant change in circumstances and under your control you're going to do different things, I think you would reconsider it. So it's focused inward as opposed to outward. Now, the lease payment, and you had an example there you were talking about where sometimes you might make payments, like in Carrefour, or you have oil containers that store gasoline, where the client might make payments based on usage. Or in Carrefour, they make rental payments based on a percentage of sales. So when you have situations like that, we would have what we call a variable lease payment. So the fixed lease payment and the variable lease payment. And what this standard basically says is we include variable lease payments if they're linked to an index or a rate at the commencement date, but we exclude them if they're linked to future performance or use of the asset. What do I mean by index or a rate? So for example, if you work in Poland or Romania or Hungary, all of those countries have their own currency. Poland is the Polish zloty. Hungary is the Hungarian forint. Romania, the Romanian lei. But in all of those countries, when you sign a lease for real estate, all of the real estate leases are fixed in euros, which is not the functional currency of your country, of those countries. So that would be an example where the lease is based on a rate. You're going to pay the local currency at the exchange rate between local currency and euros at that date. An index. In a lot of markets, what will happen is rent will go up. And rent goes up based on inflation linked to an index. So it could be the RPI, the retail price index, which is obviously the consumer price index, the wholesale price index. There are different indexes. So if the rent goes up based on a rate or an index, or it's linked to that, or it's linked to the price of oil. So you're going to pay 20 barrels of oil. It's linked to an index or a rate. Then we include those variable lease payments. If it's linked to performance, throughput, how much oil or gasoline we store, then we don't include those. So these items here, these are going to go in the income statement as OPEX, right? This is going to go into the income statement as basically CAPEX, which ends up in depreciation. So it affects the classification of how it hits the income statement. So when Carrefour pays rent, and the rent is a percentage of sales, that affects EBITDA. When you pay rent, and it's based on a fixed amount that goes up with inflation, that does not affect EBITDA. It includes things like any residual value guarantees, which I'm not sure how common they are in this market, but in some markets you guarantee that the asset at the end of the lease will be sold for a minimum amount of money. And of course, the renewal periods. So the key challenge is using the lease term. That's the key headache. What's also we're going to be doing is we want to compare the asset with the value of, with the lease payments, and we have to use the implicit rate in the lease. So compared to IAS 17, which allowed us to use the borrowing rate, in the incremental borrowing rate, in IFRS 16, you have to use the implicit interest rate, which is comparing the lease payments with the asset value. Now, is this easy to do? It depends. If it's for equipment, this is easy, because the equipment has a price, the car has a price. So when it's for equipment, you always will use the implicit rate if it's a long lease, because you know what the equipment is worth, you know the rough value of the residual, you can work out the implicit rate in a lease. So you must use that. You don't use the incremental borrowing rate. Where in the old standard, we could use the incremental borrowing rate. However, let's say, for example, I sign a lease for 10 years on this building. What's the market value of using this building for 10 years? It doesn't exist, right? It doesn't exist. We know the rental, so what you generally find is you're going to use the incremental borrowing rate on those assets where it's not determinable, which tends to be real estate, where you use the asset for a portion of its life. So,